The futures market for silver just absorbed its largest one-week delivery demand since March of 2020. That was not a squeeze. That was not speculation. That was physical metal leaving the system, and the system did not have enough on hand to fill it without stress. Over 4 million ounces were demanded for immediate delivery in a span of 5 trading days. The COMEX vaults dropped below 270 million ounces of registered inventory. Registered means available for delivery. The rest is eligible, which means it belongs to someone else. It sits there, but it is not for sale. The distinction matters now more than it did 6 months ago. When inventory falls and delivery requests rise, the futures market stops functioning as a pricing tool. It becomes a rationing system. Premiums begin to reflect that. Physical silver premiums over spot have climbed between 18 and 25%, depending on the product. That is not a retail phenomenon. That is a structural gap between what paper says silver is worth and what you actually pay to take possession. Banks are not in the business of losing money on delivery. If premiums are rising and staying elevated, it means the flow of metal into the market is not keeping up with the flow of metal out. The price you see on a screen represents a contract. The premium you pay represents reality. China imported over 6,000 metric tons of silver in the last reported cycle. That number has been climbing for 18 months. It is not for jewelry. It is not for speculation. It is for solar panels, electronics, grid infrastructure, and military applications. China does not announce stockpiling. It simply imports, refines, and does not export back. That metal leaves the global market permanently. India remains the second largest consumer. Between the two of them, over half of the world's annual silver supply is being absorbed by countries that do not financialize the metal. They use it. They do not sell it back. That creates a one-way flow. The West has been selling. The East has been buying. That dynamic worked when Western inventories were deep. They are not deep anymore. The COMEX is not the only exchange under pressure. The LBMA in London has seen drawdowns in silver held in allocated accounts. Allocated means specific bars owned by specific entities. When that metal moves, it is not trading hands for profit. It is being shipped. Once it leaves London, it does not come back. It moves to Shanghai, to Dubai, to Hong Kong. It enters markets where it will be consumed, not traded. This is not a market in equilibrium. Equilibrium means supply and demand are balanced, and price reflects that balance. What is happening now is a lag. The price has not caught up to the physical reality because most of the trading volume in silver is still synthetic. It is contracts, not metal. But contracts settle in 2 ways, cash or delivery, and an increasing number of participants are choosing delivery. When that happens, the short side of the trade has 3 options. Deliver the metal, buy the metal to deliver, or settle in cash at a penalty. All 3 cost money. All 3 put pressure on the institutions holding short positions, and those positions are large. The concentration of short interest in silver among a small number of banks has been documented for years. It has not changed. What has changed is the willingness of the long side to accept cash settlement. Physical delivery demand is rising because trust in paper settlement is falling. It is not a collapse. It is erosion, slow, methodical, and accelerating. The entities demanding delivery are not retail investors. They are funds, foreign central banks, and industrial users who see the same inventory data everyone else sees. They are acting on it. Silver supply comes from 2 places, mining and recycling. Primary silver mines are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. That means silver supply is not responsive to silver prices in the way gold supply is. If silver doubles, miners do not open new silver mines. They open copper mines that happen to produce silver. The lag time is years. And global mining output for silver has been flat to declining since 2016. Recycling fills the gap, but recycling depends on price. At $30 per ounce, recycling is profitable. At $24, it is marginal. The higher the price, the more scrap comes back into the market. But there is a ceiling. You cannot recycle what has already been recycled. And much of the silver consumed in industrial applications is not economically recoverable. It is gone. Solar panels are the largest and fastest growing source of silver demand. Each panel contains between 10 and 20 grams of silver depending on the technology. Global solar installation capacity is growing at 20 to 30% per year. That growth is policy driven. Governments are mandating renewable energy. They are subsidizing solar. That demand is not price sensitive. A solar panel does not get cheaper if silver goes to $40. It gets built anyway because the policy requires it. That creates inelastic demand. And inelastic demand in a supply-constrained market does one thing. It moves price. But it does not move price smoothly. It moves it in steps. Long periods of consolidation followed by short, violent moves higher. Silver has always traded this way. The difference now is the consolidation phase is compressing. The last time silver broke $30 and held it was in 2021. It failed because industrial demand was weak and investment demand was speculative. This time industrial demand is structural. It is not going away. Solar is not optional. EV production is not optional. Grid infrastructure is not optional. These are multi-decade build-outs that require silver at every stage. Investment demand is returning, but it is not speculative. It is defensive. People are not buying silver because they think it will double. They are buying it because they do not trust the alternatives. Bond yields are unstable. Equity valuations are stretched. Real estate is illiquid. Cash loses value by design. Silver is portable, divisible, and has no counterparty risk. It does not care what the central bank does. Central banks have been buying gold at record levels for 2 years. They have added over 2,000 tons to reserves since 2022. They are not buying silver because silver markets are smaller and less liquid. But the motivation is the same. They are diversifying away from dollars and euros. They are buying hard assets. And when central banks move, they do not move back. The ratio between gold and silver has been compressing. It was over 90 ounces of silver to 1 ounce of gold in early 2020. It is now in the low 80s. The historical average is closer to 60. If that ratio reverts and gold stays where it is, silver does not go to $35, it goes to $45. If gold moves higher, which it has been, silver goes further. But ratio trades are backward-looking. They assume history repeats in the same proportion. What is happening now is not a repeat. It is a supply shock layered onto a demand surge, layered onto a loss of confidence in synthetic pricing. Those three forces do not produce a reversion to the mean. They produce a repricing. Repricing does not mean silver goes up 10%. It means the market realizes the current price does not reflect the cost of acquiring physical metal at scale. And once that perception sets in, it does not reverse. The new floor becomes the old ceiling. That has happened twice in the last 50 years, in 1980 and in 2011. Both times, silver moved from under $10 to over $40 in less than 2 years. Both times the move was dismissed as a bubble until it was not. This is not 1980. There is no Hunt brothers cornering the market. This is not 2011. There is no European debt crisis driving fear trades. This is a structural deficit in a globally critical industrial metal that also happens to be a monetary asset. That combination is rare, and it is unstable. The banks that are short silver are not speculators. They are market makers. They provide liquidity. They sell contracts to hedge funds and buy metal from miners. In a stable market, they profit from the spread. In an unstable market, they get caught. And when they get caught, they do not take losses quietly. They manage their exposure. They reduce their short positions. And the only way to reduce a short position is to buy. If a concentrated short position begins to unwind in a market with tight physical supply, the price does not rise gradually. It gaps. It moves faster than participants can react. That is what happened in March of 2020. Silver dropped to $12 and then ran to $30 in 5 months. The futures market lost control of the price because physical demand overwhelmed synthetic supply. The difference now is the starting point. Silver is not at $12. It is at $30. Inventories are not high. They are low. Short interest is not falling. It is elevated. And foreign demand is not speculative. It is structural. The setup is tighter than it was 4 years ago. The ETFs are not helping. Silver ETFs are supposed to provide exposure without the need to hold physical metal. But ETFs hold metal in trust. When you buy shares, the ETF buys silver. When you sell shares, the ETF sells silver. Except it does not always work that way. During periods of stress, ETFs can trade at premiums or discounts to net asset value. That is a signal. It means the market does not believe the ETF can deliver metal at the stated price. SLV, the largest silver ETF, has seen outflows and inflows that do not match the price action. That is unusual. Normally inflows happen when price is rising. What is happening now is inflows during consolidation. That suggests accumulation. Someone is buying size, and they are using the ETF structure to do it without moving the spot market. That does not last. Eventually, the ETF has to buy metal to back the shares, and when it does, it competes with everyone else trying to source metal. The mints are running behind. The U.S. Mint, the Royal Canadian Mint, and the Perth Mint have all reported delays in delivering silver bullion products. Delays mean demand is exceeding production capacity. These are government mints. They are not small operations. If they cannot keep up, it is because the refiners cannot keep up. And if the refiners cannot keep up, it is because the metal is not there. Refiners do not stockpile. They process. They take 1,000-ounce bars and turn them into coins, rounds, and smaller bars. If refiners are behind, it means the 1,000-ounce bars are not flowing into their facilities at the rate they need. And those bars come from two places: mining output and COMEX deliveries. Mining output is flat. COMEX deliveries are under stress. That is not a bottleneck. That is a shortage. Shortages do not resolve with time. They resolve with price. Price has to rise enough to either pull supply out of hiding or destroy demand. Supply is inelastic. Demand is inelastic. That leaves price. And price has not moved enough yet to matter. It will. The narrative around silver has been the same for a decade. It is a speculation. It is a niche trade. It is a relic. That narrative is breaking, not because of YouTube videos, not because of retail enthusiasm, because the physical market is separating from the paper market, and when that happens, the paper market loses credibility. Credibility is all a futures market has. If participants believe the contract will settle fairly, the market functions. If they do not, the market fragments. Fragments do not mean collapse. They mean bifurcation. One price for paper, one price for metal. The gap between them is the premium, and the premium is rising. Banks do not like bifurcated markets. They cannot hedge in a bifurcated market. They cannot arbitrage. They cannot manage risk, so they push for convergence. They raise margin requirements. They limit delivery sizes. They settle in cash. All of those are tools to reduce physical demand, and all of those are being used right now. When a market starts rationing access, it is not healthy. It is stressed. And stress in a commodity market means one thing: the price is wrong, it is too low. If it were too high, there would be no stress. Sellers would flood the market, inventory would build, premiums would collapse. None of that is happening. What is happening is the opposite. Sellers are holding, inventory is falling, premiums are rising, and the entities with the most to lose are the ones setting the price. That is not a sustainable structure. It is a coiled spring. The comparison to NVIDIA is not about technology. It is about positioning. NVIDIA ran because institutions were underweight and had to chase. Silver is running because institutions are short and will have to cover. The mechanics are different, but the result is the same. A violent, one-sided move that does not stop until positioning is reset. NVIDIA went from $150 to $500 in 18 months. Silver does not need to go to $500. It needs to go to $60. That is a double. And a double in a commodity market with this much short interest and this little inventory does not take 18 months. It takes 18 weeks. The target of $200 is not a forecast. It is a mathematical outcome of a market that loses faith in synthetic pricing. If silver trades like a commodity, it goes to $60. If it trades like a monetary asset, it goes to $100. If it trades like both at the same time, during a period where neither bonds nor equities are trusted, it goes higher. $200 is not the upper bound. It is the midpoint of a repricing event that has not started yet. But repricing events do not announce themselves. They do not wait for confirmation. They begin quietly. A few large orders, a few failed deliveries, a few funds that decide to take metal off the table. And then it accelerates. And once it accelerates, it does not stop until the short side capitulates. Capitulation does not mean bankruptcy. It means covering. And covering in a tight market means paying whatever the offer is. There is no bid. There is no negotiation. There is only the price at which someone is willing to sell. And that price is not $32. The rotation out of equities and into commodities has already started. It is not broad. It is selective. Copper, uranium, lithium, and now silver. These are not speculative trades. These are supply deficit trades. The market is pricing in scarcity. Scarcity does not mean zero. It means not enough. And not enough is all it takes. Silver is not a safe haven. It is not insurance. It is not a hedge. It is a supply-constrained industrial metal with monetary properties entering a period of surging demand and falling trust. That is not a trade. That is a trap. And the people caught in it are not retail investors. They are the institutions that spent a decade telling everyone silver did not matter. It matters now, not because of sentiment, because of flows. And flows do not care about narratives. They care about availability, and availability is falling. The next 6 months will determine whether this is a move or a breakout. Moves retrace. Breakouts do not. The difference is volume and duration. If silver holds above $30 through the summer and closes the year above $35, the breakout is confirmed. If it closes above $40, the repricing has begun. And if it closes above $50, the market is fractured. Fractured markets do not repair themselves quickly. They overshoot, they gap, they leave participants behind. The entities that are long physical metal will not sell into strength. They will hold. The entities that are short paper will not hold into weakness. They will cover. That asymmetry creates the fuel for a vertical move. Vertical moves do not last, but they reset the range, and the range is what matters. Silver spent a decade between $14 and $28. It is now between $28 and $34. The next range is $40 to $60, and the range after that is $70 to $120. Each range takes less time than the last because the structural deficit is compounding. Compounding deficits do not resolve with new supply. They resolve with demand destruction or price rationing. Demand destruction in industrial metals means recession. Price rationing means the buyers who need the metal pay more, and the buyers who want the metal step aside. Neither outcome is bullish for the broader market. Both outcomes are bullish for silver. This is not about making money. This is about understanding what is happening beneath the surface of a market that is pretending everything is fine. Everything is not fine. The inventories are not fine. The deliveries are not fine. The premiums are not fine. And the entities managing the system are not fine. They are stressed. And when stress turns to panic, the price does not rise in increments. It rises in leaps. And the people who are not paying attention do not get a second chance to enter at the old price. They either pay the new price or they watch. The window is closing, not because of a deadline, because of flow. The metal is leaving, it is not coming back, and once it is gone, the paper market will have to reconcile with the fact that it no longer controls the pricing mechanism. That reconciliation will not be smooth, it will be abrupt, and it will be expensive for everyone on the wrong side. The institutions know this. They are not blind. They are trapped by their positions, trapped by their mandates, trapped by the fact that unwinding a short in a rising market is more painful than holding it and hoping it reverses. But hope is not a strategy, and the market is not reversing. The buyers are not going away. China is not slowing its imports. India is not reducing consumption. Solar installation is not stopping. And the funds that are demanding delivery are not changing their minds. They see what the banks see. They are just acting on it faster. This is the rotation, not out of tech, not out of equities, out of synthetic exposure and into physical possession, out of trust and into control, out of paper and into metal, and it is not happening in headlines. It is happening in vaults, in shipping manifests, in refinery queues, in the spread between spot and premium. The signal is clear, the market is separating, and when it finishes separating, the price on the screen will no longer represent the price of the metal. It will represent the price of a contract that fewer and fewer people believe will settle fairly. That is not a conspiracy. That is a market in transition. And transitions in commodity markets are not gentle. They are disruptive. They are fast. And they are irreversible. The metal is moving. The system is straining. And the price is lagging. That lag is the opportunity. But it is also the warning. Because once the lag closes, the move begins. And once the move begins, there is no going back to 30. The market is telling you something. It is not shouting. It is whispering. But it is consistent. And it is accelerating. The institutions are listening. The foreign buyers are listening. The question is whether you are,